What is going on, guys? We're going to be breaking down order flow all throughout from beginner to advanced in this video, guys. If you don't know what order flow is, it's a real-life cheat code to reading the market. You got to understand that every other fucking crazy lagging indicator you're using, whether it's MACD, RSI, I've been there, EMAs, all this bullshit is not really giving you much information. If you're looking at a candlestick chart, all you're really seeing is where price was in the past and where price currently is sitting right now. You're kind of giving yourself a fat disadvantage if you're not looking at actual volume coming in, right? Imagine you have a tool that lets you see all the resting liquidity sitting in the market, exactly where it is and what price point it is. Imagine there's a tool that lets you see exactly how much volume of aggressive buying pressure, aggressive selling pressure is coming in. Imagine if there's a tool that can literally show you exhaustion, buyers, sellers dying out, absorption. Imagine if you have all that information combined to whatever strategy you're trading right now. If you're not trading a strategy, this is awesome because you don't have to unlearn all the bullshit. It's going to give you a huge advantage and honestly increase your win rate significantly and give you a much clearer understanding of how the market works. So a lot to go over today, guys. I don't want to get too crazy right now. Let's just get right into it, guys. The very end, I'm always going to give you all some tips and tricks of how you can actually use order flow to execute and enter trades in real time. So hopefully that will help you guys. So stay tuned for the whole video. But before we get into actual order flow, how to read it, how to use it, how to trade it, we have to understand what the fuck it is. What are we looking at? What is order flow? When I say the words order flow, what am I talking about exactly? So order flow is the stream of buy and sell orders hitting the market in real time. So these are the offers. These are the actual volume of orders coming into the market. Now, a lot of people think there's buy volume and sell volume. That's just not the case because there's two sides to every single transaction. So if one person's buying, one person's selling. It has to have two sides met for the order to get filled. So what we look at is the orders hitting the market, the orders hitting or market orders and limit orders, the orders hitting the bid, orders hitting the ask. We'll talk about that in a second to really tell who's in control, right? Because if you're just looking at simple old volume, we don't know if it's aggressive buyers. We don't know if it's aggressive sellers. We really don't know much. So it shows who's buying and selling aggressively and where liquidity is sitting. Liquidity sitting here is a huge part, and I'll tell you about that later. But candlesticks show you results. Order flow is showing you the cause behind the price movement. So you're not going to be behind after a move happens. You're looking to be ahead. You're looking to be ahead. Now, to understand order flow, you have to know the difference between the bid, ask, and the spread. The spread doesn't really matter to us because we're trading highly liquid instruments, and I'll talk about that in a soon as well. But don't want to digress here. I want to get it, step by step so you all understand what this is and how to actually use it. So bid, right, equals the buyer's limit orders, the highest priced buyers are willing to pay. Now, if you take a look, when you're looking to buy something, right, you always see that there's two prices. Prices the sellers are at and prices the buyers are at, right? You have the bid and the ask. Every time you buy something, you're going to be a little bit in the red. Every time you sell something, you're going to be a little bit in the red because there's a difference between the price the seller is willing to accept and the price the buyer is willing to pay. So the bid equals the buyer's limit orders. This is the highest price buyers will pay to get into something, right? So when a seller hits the bid, it's an aggressive sell because this seller is selling at a cheaper price, right? If a seller is selling at a cheaper price, he's being aggressive. You just think about it, right? You want to buy low and sell high. So if you're willing to sell at a cheaper price, you're being aggressive. You want to get it right now. It's the exact opposite for the other side. So ask is the seller's limit orders. The lowest price sellers are willing to accept. Okay, so again, very important here. The ask is the lowest price the sellers are willing to accept. Now, when a buyer hits the ask, it's an aggressive buy offer. Why? Because this buyer is paying a more expensive premium to get into his position. He's willing to pay a higher price, so he's being aggressive. So the ask will always all the time be higher depending on how volatile it is. But the spread is the difference between the bid and the ask, right? So the sellers want to sell at 55. The buyers want to buy at 50. Right? So the difference in both of these is the spread. Now, if you're trading ES and NQ, you don't have to worry about the spread. It's usually super tight, like no margin. It's super, super tight. But if you're trading something with, a wider spread, means just thin or volatile market, tight spread, active market, lots of liquidity. That's basically what it is. So we don't really care about spread because we trade a very, 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 very liquid instrument. So order types, the next thing you need to understand to actually read order flow is the difference in order types. And to give you an example before we actually get into the definitions, imagine so there's limit orders and market orders. So imagine there is an investor who wants to buy Apple at $100, but Apple is currently sitting at $150. He'll put his order in the market. It's a working order at $100 to buy Apple. His order will not get filled unless Apple gets down to the $100 mark. Now, aggressive participants, right, they're called market orders. Now, what this means is, let's say you go into a restaurant and you're looking to order food and everything has a price, and you look at lobster, and next to lobster it says market price. There's no price listed. This means that whatever the current price of lobster is, depends on the season, depends on where you're at, the price will change, is what you're going to pay if you want lobster then and there. So you're being aggressive. So what this is telling you, right? Limit orders are passive. Orders waiting in the book at a set price provide liquidity. This basically is liquidity. You see them on Bookmap as heat levels or in the DOM as resting orders. We'll look at that in a second as well. Market orders, aggressive, right? Execute instantly at the best price available. Think of the lobster analogy. They take the liquidity and they represent the real buying and selling pressure of the market. So hopefully that made sense to you guys. But moving on, right? Passive traders provide liquidity with limit orders. Obviously, aggressive traders remove liquidity with market orders. Price moves when aggressive traders consume available liquidity. Super, super important. Make sure you memorize this. Now we can actually get into how to read order flow and how to actually use it into your trading system, into your trading plan. There's a lot of different things you can do, but we're going to talk mostly about Bookmap and footprint charts, how to read them, how to use them, and actually execute with them, which for me is something super, super important. Now, the heat map, this right here, you probably see me use this all the time. And a lot of people get so confused when they see this. They think I'm trading astrology or bubbles or some random shit that doesn't even make any sense. But this is super simple to read. Like, understanding all of this will give you a very, very, very good indication of how to read this. And I'm going to tell you exactly how. So the heat map shows resting liquidity. So when you see all of these orange and dark red lines, you're seeing the resting limit orders, liquidity in the market. Remember that investor on Apple? So basically, if it's below the current price, these are resting buy offers, right? If it's above the current price, or they're resting sell offers. And they can get pulled. Remember that. They can get pulled really, really fast because limit orders can get pulled. You can put an order to buy $1 million in Apple at $100, and right when Apple gets to 101, about to be at $100, you pull that offer and it doesn't get filled. So remember that. Now the bubbles, right? Completed trade. Size equals volume. Colors equals buy or sell. So these are the aggressors. So if it's a green one, these are our offers, right? Hitting the ask. These are buyers who are willing to pay at a more aggressive price. They're getting filled. The bigger it is, the more volume it is. And the red is just the opposite. The seller's hitting the bid. The bigger it is, the stronger it is. So we kind of understand that for this wave right here of 585 to get cleared out, it must be met by an aggressive market order of 585 hitting gas, right? If that wants to clear out. Pretty simple right here. There's 585 offers of sellers. For this to get broken, you need 585 buyers. And this is a multiplied by 100 or 1,000. I think it might be 1,000. So it's not actually 585. Like, this line right here is hundreds of millions of dollars. To make a line on Bookmap, you need to have hundreds of millions of dollars, which is why this is showing us the institutions, the banks, the hedge funds, the governments. It's not showing us the retail traders. Like, there's no matter, all the retail traders could put an offer and it still wouldn't be on Bookmap, just to give you an example of why this is important, why this shows us the smart money. Now, liquidity pulls. You will see liquidity being pulled all the time. We actually took an entry today on liquidity being pulled. So we sold off here. Liquidity got instantly pulled and front run back down. You see algos do this shit all the time as an entry for longs. Blasted up about 10 points, right? Again, we'll talk about that in a little bit as well at the end of the video. But basically, if you see liquidity getting pulled, a breakout potential as well, because let's say you have all these offers here, or pushing up with aggressive buying, all the offers disappear. Now there's nothing stopping the aggressive buyers, right? The difference between liquidity being pulled and the difference between algos front running. So if y'all want, I have a bunch of videos on my channel talking about all this. If y'all want a more advanced Bookmap analysis video, comment down below in the description, or honestly, join my free Discord down below. DM me or at me in the free Discord, or leave a comment, honestly, and I'll get to you. But highly recommend you join the free Discord. It's honestly a great educational resource. We have a bunch of educational content on there. We do free lives occasionally, free live charting sessions occasionally. I post my trade recaps in there daily. I'm very active in the chat, talking to all y'all. So I'll leave the link down below. It's free, costs you nothing. And honestly, it's a great thing because trading can get pretty lonely. So make sure you're in that free Discord. If you're not, you're missing out. Promise you that. But other things you can see, absorption, large wall hold. So basically what we saw today as well, we saw some absorption from sellers. You see a bunch of aggressive sellers hitting these passive buy offers, 87s. And what happens? There's more passive buyers and there is aggressive sellers. So it holds. All these offers get absorbed. And we can see that as well. We're going to get into the footprint charts here in a second. We can see all that absorption happening in the footprint charts as well. And then icebergs. Icebergs are just a bunch of, basically, if a big participant wants to get in the market, they're not going to put in $1 billion offer on one specific price level. They're going to break down their offer so they get a good fill. If they want to get filled $1 billion at 42, no way in hell they're going to get all those offers filled at 42. They're going to have crazy slippage. But if they break it down a little bit at 40, a little bit at 42, a little bit at 45, they have a better chance of getting a good average, right? Because imagine $1 billion hits right here. As soon as that hits, it's so much liquidity, the market's going to just go crazy. So they don't want to do that. They don't want to tell people that they're going to be, like, this is kind of how they hide their offers. They don't want to tell people that they're going to be getting in at a fat position here. They want to make it secret, unseen, right? Which is why you have dark pool and all this other crap involved, but they spread it out. They create iceberg orders. And then the last thing to talk about is long time frame liquidity. So because algos go crazy, right? This is basically showing you a chart with time and then price, right? Same thing as a candlestick chart. So you can actually see how long an offer has been sitting on Bookmap for. For this 925 offer right here has been sitting on Bookmap for days, for hours. And the longer the liquidity has been sitting there, the more likely it is to actually get filled and not get spoofed or pulled out, and actually acts as a magnet. So I use these levels to take profit levels a lot of the time. So a lot of times it matches up with big psychology levels. I can't speak, like the 50s, 55s, 100s, things like that. But again, long time frame liquidity is a thing. The more time it's on there, the more likely it will get hit and filled, and the more likely it won't get pulled. Now, the next thing we use to read order flow is going to be the beautiful old footprint chart. Love footprint charts. Basically, what I just showed you. The difference between footprint charts and actual Bookmap is you cannot see the level 2 on footprint charts. Basically, you can't see the resting liquidity on footprint charts. You can make an assumption, right? What that means is, for instance, on this play right here, we have all this aggressive selling offer. Like, look at the aggressive sellers down here. I'm gonna actually tell you what footprint charts are and how to read them before we get into an example, so it makes more sense. But basically, I have a bunch of videos on my channel about candlesticks. If you want them more in depth, I'll try to link it right here. But if not, just go look at my channel. Each sell is bid volume x ask volume. So what this is meaning is one side shows you all the offers hitting, all the aggressive sell offers, and the other side shows you all the aggressive buy offers, right? Green is buying pressure, red is selling pressure. So basically all these bubbles you see on Bookmap are being plotted on a candlestick for you on one side and on the other side. So it's a different visual representation of order flow, basically showing you the same thing except for the level 2, obviously. But there's imbalances. We're going to talk about these imbalances in a second. Green imbalances, red imbalances, continuation imbalances, sell side imbalances, a bunch of different kinds of imbalances we're going to talk about here soon. But imbalances are awesome. We use them for entry triggers. It shows you the absorption. So basically what I was showing you here on the footprint chart, right? You see on the left side of the sellers, all these crazy sellers coming into the market, yet price doesn't move down. So what it's telling you without looking at the level 2 is that there's a lot of passive buy offers sitting here absorbing all those aggressive sellers, and you get a buy imbalance. The market then shoots up, right? It can show you absorption as well. We just show that. It can show you exhaustion, by the way, because not only do you see the buyers and selling pressure volume, you see volume in general. So this blue histogram is showing me the total volume of that candle. Each 5-minute candle, it gives us the V, the volume, the D, the delta. The delta is the difference between aggressive buyers and aggressive sellers. So for instance, on this candle, we had negative 3,000. We had 3,000 more aggressive sellers than we had aggressive buyers, yet price didn't move down because it got absorbed. It could also show you volume dying off. So you can kind of tell the very tippy top of this candle, there's absolutely not any volume. And the market is an auction. So if we move up and the volume dries off at the top, right, nobody's interested in higher price points. So the market must then reverse back down to get people to play, to get people to be active again. The main purpose of the market is to advertise price and facilitate trading. So if nobody's trading at higher price points, volume's dying out and it must come back down. And we use that as a major confluence. Now, to talk about imbalances here, right? Imbalances can be tricky for some people, but what they are is, to me, simple. There's two kinds of imbalances. There's continuation imbalances and reversal imbalances. Let's quickly get into the definition before we get into the examples. But red candle, right? A red imbalance shows sellers dominating, an abnormal selling activity, and price likely continues down. This is the opposite for the buy side. Often accompanied by strong delta and volume confirmation, meaning volume getting bigger and bigger. And then tip, look for follow through on the next candle after the retest. I'm going to show you exactly what that means. And then reversal imbalances, two kinds of imbalances. These imbalances appear at the extreme ends of a candle, signaling exhaustion, right? These are for reversal signals. Top of a green candle, green imbalance at the very top with no ticks above, bearish reversal. Bottom of a red candle, red imbalance at the very bottom with no ticks below, bullish reversal. Usually again, it's accompanied by dead or declining volume showing a lack of follow through. And tip, I use this as an entry trigger for a reversal. So continuation, you get a big green delta candle, right? Fat, and you get a buy imbalance being plotted. I don't draw these to get plotted for me. Basically what an imbalance is, again, I have videos on imbalances on my YouTube channel, but it's a diagonal divergence in price. So it's showing you abnormal activity. So it's not vertical, it's not horizontal. It's from the 400 to 200 to the 28 to the 1.5K, and it'll plot a crazy imbalance for you. Now, what I do with these imbalances, I use it as a key level for entry. So basically, if we push down into the imbalance, right, or let's just use this for an example. If we are looking for an entry long right here, but we don't see a trigger right here and price aggressively moves up and makes this imbalance, then what I'm waiting on is for price to come back down, test the imbalance for an entry long, right? Put my stop loss below the imbalance, create a validation. That's what I use these continuation imbalances for. Honestly, it's a pretty smart way to use them, because if you miss an entry, You need extra confluence, extra confirmation. If you wait for that imbalance retest, your win rate is going to be significantly higher. Now, the same thing right here. Reversal imbalances are a little bit different. So right here, we have a continuation imbalance and a reversal imbalance. The reversal imbalance will show at the very, very bottom of a candle or the very, very top of a candle, not a single tick going below. This is an example of a great entry trigger because we see continuation imbalance, then we see us tap the continuation imbalance with the reversal imbalance. So this is a great entry trigger. Basically, we'll use these imbalances as reversal signals. Let's see if we have an example here in real time of a reversal imbalance as a signal. So right here, perfect. Saw one in key right away. Reversal buy side imbalance, and then the market instantly sells off. So it's a great entry trigger to use. I have, again, a bunch of videos on imbalances on my YouTube channel. Y'all feel free to look at them and feel free to use them because they're going to help you out a lot. Now, final thoughts here, right? How y'all should use these is watch the delta. Ask minus bid volume to gauge real pressure. So it shows you the difference between buyers and sellers. So you can kind of give a good example, especially longer time frame of who's in control, who's getting absorbed, who's getting exhausted. Don't chase the bubbles. So don't just get in long because you see a massive green bubble or get in short because you see a massive red bubble. Wait for confirmation. Wait for the delta shift. Wait for absorption. Wait for exhaustion. Wait for a clear picture to be painted. Combine bookmap and footprint charts. So use bookmap to view the liquidity and footprint charts for a better view of aggression at a higher time period. And what I mean by that is, honestly, bookmap, it's kind of cluttered, kind of crazy. It's not the best example. It's really good for executing, but if you're performing analysis, it's not the best. Much, much cleaner picture when you're looking at the aggressors when you're looking at the footprint charts. It's much prettier. Now, focus only around key levels. Don't drive yourself crazy by watching order flow at random locations. VWAP, highs and lows, liquidity, prior day levels, supply and demand. Focus only at these key levels and you'll have a much better time. Simplicity is going to win. Just identify where liquidity is sitting and how it reacts, and you have a great, great time. Guys, remember, is order flow a god tool that's going to make you $1 billion in 3 seconds? Absolutely not, right? Is order flow going to make you rich? I don't fucking know, right? I don't know who you are watching this video. I'm not trying to make any income claims, but I started to see real success in my trading when I started to view order flow. That's when I started to see real success. So make sure y'all check out the free stuff I have down below. And if you're ready to kind of take a big step and kind of fast track your learning curve and actually get into trading and see success a lot faster than you would do on your own, just going through YouTube videos, I have a couple seats that just opened up in my one-on-one mentorship. Basically, you get one-on-one mentorship by me. You get to see us live trade every single day. So you get to make money while you learn by copying someone and by watching someone who's been doing it for literally 10 years. You get free funded accounts. You get, honestly, a great VIP community. You do ask you some questions. You're not just going to sign up. You have to get on a call with me. I have to talk about you, who you are. I don't want people who are looking to get rich quick. I want people who are ready to go, smart, disciplined, and people who can actually see improvement fast. The spots are so limited because I'm only one person, so I will ask you a bunch of qualifying questions just to make sure that you're not just anybody joining in, guys. But again, hope you all enjoyed this video. I'll talk to you later. Peace out.